Is it really possible to make $5 million in 25 years? I'm going to share my plan with you coming up. Wait, don't share this with your financial analyst. Hey guys, my name is Raj and welcome to Think Finance. On this channel, I talk all things finance. The goal is to take our hard-earned money as far as possible. I'm going to break this video into 3 parts. 1, the overall plan. 2, how do I make it real? And 3, how do I track it? Alright, let's start with the plan. For the next 25 years, yes, that's my time horizon. For the next 25 years, assuming I'm alive, I will be investing 85% of my money into stocks and ETFs. The remaining 15% will stay in cash. Wait, why cash? Guys, we live in a world of tweets. One nasty tweet from a president and the markets go south. When that happens, you will have cash in your back pocket to buy the dip. 15% is no magic number. It's a number I'm going with. It could be 20% for you. Next, I need a trading platform. I'm going with M1 Finance. It's something that I've decided to use. It works for me. It gives me the right set of features, including commission-free trading, buying fractional stocks, portfolio rebalancing, dividend reinvestment, and a few other set of features that seal the deal for me. It also has a pretty slick website and an app. So M1 Finance is where I'm going to be investing all my money. If you want to open a brand new account on M1 Finance, there's a link in the description. Full disclosure, it's a referral link. I think you get something, I get something, we all are happy. This plan is based on 2 core principles. 1, dividend reinvestment, and 2, growth. I want to be able to leverage the power of compounding. Any dividend that this portfolio generates will be reinvested in the account. 2, growth. Of course, I want to accelerate my progress. I'm talking about 5 million in 25 years. So I'm going to throw in some growth stocks and ETFs in the mix. All right, so that's the plan. For the next 25 years, I'll be investing 85% of my money in stocks and ETFs, 15% in cash using M1 Finance, and it'll focus on dividend and growth. All right, so how do I make this real? Let's start by talking about funding and funding sources. My wife and I, we make enough money to set aside a decent chunk of money. Every month, M1 Finance will pull $2,000 automatically from my checking account and drop it into my M1 Finance account. This is going to be fixed. Rain or shine, this is happening. Then there is variable income. Surplus income may or may not happen. Found a new job, got a huge signing bonus. Does not happen, but what if it did? My mother-in-law wrote me a check. Why? Because I'm a great son-in-law. That's not true, but what if that was true? I do a lot of options trading. On and off, I get lucky. I make decent chunk of money. All of this money, which is variable or what I call it as surplus, will also move into my M1 account. So 2 sources, fixed, variable, checking account, $2,000 a month, and then 2, anything variable or surplus that I make in a month. All right, let's take a closer look at where I'm investing. This is the money slide. 50% of my money goes in high yield dividend paying ETNs. These track dividend stocks on Dow Jones and S&P 500. Together, they give me 6% dividend annually. Wow, 6%. This meets my first goal of dividend and reinvesting dividend. All the dividend that I get out of these ETNs gets reinvested into my account. The next 35% goes in leverage ETFs. These track the NASDAQ 100, technology sector, semiconductor sector, and S&P 500. Wait, what is leverage ETFs? I'll do a separate video on this topic. For now, understand that if the market goes up 1%, a 3x leverage ETF goes up 3%. And if the markets drop 1%, a 3x leverage ETF drops 3%. There's a lot of debate online discussing why leverage ETFs is not the right choice for a long-term portfolio. I think otherwise, I have done my research and I believe this is the right tool to accelerate growth in your account. Again, I'll do a separate video on this topic, so subscribe to get notified. The final 15% goes in dividend growth stocks. Think Apple, Microsoft, Nvidia, Verizon, J&J. They hit both dividend and growth. I'm estimating 10% return annually on this portfolio. Wait, 10% is too much? Maybe. Over the last 50 years, S&P on an average has given us 8% return. Now we throw in some leverage ETFs, some dividend growth stocks, 10% is not a bad number. In addition, this basket will give me 4% dividend, which will be reinvested into the portfolio. There were other investments that I considered. Real estate, for example. Decided not to invest in real estate. I've got too much going on in real estate already. Global stocks, emerging markets, Europe. Decided not to do that. Strongly believe US is the place to be in. Bonds, too conservative. I'm investing in leverage ETFs for crying out loud. All right, that's the plan. The secret is out. There's a link in the description that takes you to M1 Finance for more detail. So how do I track this? Wait, why do I need to track it? I thought this was set it and forget it. True, I want to make sure that I stay on track, and if I'm not, I want to make the adjustments. Tracking allows me to do that. Here's a snapshot of the spreadsheet that I use to track my progress. Remember the three numbers? $2,000 a month, 10% annual return, and 4% annual dividend. Once I throw those numbers in, the spreadsheet automatically calculates my portfolio value at the end of 25 years. This is the current state of my portfolio as it stands today. I started my M1 Finance account in September 2019, and recently market has been on a tear, so it's been easy going. We'll see how it goes. All right, that's the plan, guys. There you go, you have it. Let me know in the comment section what you guys think. Again, I'm not a financial analyst, CFA, CPA, nothing. I'm just a regular investor trying to make a buck. Thanks for tuning in. If you find this content interesting, smash that like button and consider subscribing. Until next time, peace.